Welcome to Breaking Ground. I'm excited today to have with us our SVP of Research and Analytics, Jason Thomas, who's been with us for about 18 months now, and Robin Schneiderman, our amazing Senior Vice President, Managing Director, and all things new development. Thanks for coming over, guys. So today we're going to be talking about market reports and how our industry for years, decades, has used the same analytics for market reports, and how Robin and Jason have broken that mold and really changed the way that we look at information in order to best advise our clients and provide market reports that really mean something. So guys, start us off. You guys met about 18 months ago. As you were just saying, Robin interviewed the crap out of you, right? And we decided that you were the perfect fit to revamp the way that we look at data, analytics, and the market. So Jay, give us a little bit of insight and tell us also a little bit about how you came into this industry and you know, a little bit about your background, because I think that's really important in discussing how we're now analyzing the market.
Okay, so thanks for the introduction. Came into the market, I've actually been an active agent since 2011, so 14 years now, or close enough. Before that, I had a registered investment advisory, so managing money. And before that, I was a grad student in chemistry. So what weaves together all of these things is a desire for questions, you know, answers to questions, for digging in deeper and deeper and deeper and deeper. And really, I've spoken to you about this, Steve and Robin too, what it all comes down to is trying to find the truth in certain things. Not just to say, well, I dug in a little bit and this is what it appears to be, to dig further and further and further until I can say without a fraction of a doubt that I believe this to be true.
Did you find your greatest challenge in me?
Yes, but also a sharpening tool. Robin is, I think I've met my match in terms of the desire to dig into the data and truly take away all the things that are distractors and the things that lead you down paths that aren't really the right way or the right answer, and find the right answer. Robin is very much the same way as I am about that.
Yeah,
so
without a doubt.
It's good.
Yeah. So Robin, as you started to work with Jason and really kind of peel back the data information, I know then there were a lot of growing pains, right? Jason would come up with ideas. Robin wasn't sure because we've been doing things a bit of the same way, you know, with two different research directors for a number of years, right? So it's always hard to change. What sparked interest in saying, okay, let's really tear this thing apart. Let's really see how we can better analyze the data. Because new development data is difficult, right? Because it's trailing 2, 3, 4, 7 years sometimes.
Yeah, I mean, I think it first started with macro versus micro. And I think it was critical for us to be able to give what I would say a true state of the market. And a true state of the market is looking not only at the current climate, but also some historical data. So we took the challenge to go back 10 years and identify trends going forward. So I would say that the first probably 3 or 4 months was data gathering, which Jason did a wonderful job at, and also working with our partners at Market Proof.
Thank you, Kale.
Yes.
And Ning.
And really, my goal was to give a holistic approach of what's happening in the market, because really what happens is daily, Steve and I get calls from developers, and they want to know what's happening today. They want to know what's going on in the past and what's the future look like. And that was the goal. The goal was to give history, present, and future. And I think we accomplished that.
So Jason,
well said,
speaking about that, you've come up with an amazing analysis of how to actually kind of look in the past to predict the future. Tell us a little bit about that, because that really was the catalyst for changing all of our market reports and really giving Robin a lot of ammunition and a lot of information in order to better guide developers on what's possible on a development site so that they can bid the right number to win that site develop that site, work with us to develop the best unit mix, the best pricing, et cetera. So what led you to that?
Well, and I'll answer that. I was going to go back just for a moment. I think what's missing, so some would call it, bumping heads, right? What Rob and I did in the first, even maybe year, but I don't see it that way.
Yeah, I played the referee.
I think what's absent in the industry is peer review. So what you have is a lot of preconceived notions or predefined narratives, and then people will cherry pick the data to support those narratives. And what Rob and I did was, it was peer review. If I had a narrative, he would say, wait, let's look at it this way. Or if he had one, I would say, wait, let's look at it this way. And what we did was a series of this peer review where we produced really strong, rigorously vetted data. So I think that was a big part, was sometimes a little bit of friction is the best opportunity. So about the data and the way we're looking at things, the realization that served as the spark plug for our new methodology and philosophy, it's revolutionary in New York City, perhaps, but it's certainly not new, and it's certainly not proprietary. So if you look back 40 years, this was what started the Case-Shiller Index, okay? It was the basis for the generation of that. And it's no one's IP. It's no one's intellectual property. It's just simple and irrefutable mathematical and statistical truths. And that's all it is. We haven't invented the wheel here.
So what is that truth?
Okay, that's the right question to ask. What the industry does now, or has done for a long time, is to spend a lot of time with the price metrics, okay, with price and price per square foot, to plot these out, to calculate the change in between periods, and to opine and make or extract, glean insights from these and speak to the audience, whether that be developers, agents, or the consumer, right? And where that's problematic is that the basket of apartments in one reporting period is 99 to 100% different, usually 100% different than the next reporting period, and so forth and so on. Mm-hmm. There is literally almost 0 to 0 overlap between the data sets.
So, thus quarter-to-quarter comparisons really don't work very well, particularly in new development.
But even, single family can be more similar, but especially multifamily, because in single family on a street, all the houses, they may different square footages, but they're all similar enough. Mm-hmm. But when you're looking at a condo on Central Park South, where one faces away from the park and one is on the 90th floor facing the park, that is literally night and day difference, right? So what we say now on page 1 as a disclaimer of our report, literally conspicuously on page 1, is that because the units sold or under contract differ significantly or most of the time entirely between data sets, we cannot rule out that the differences that we observe are due to nothing more than differing data sets. They're not actually changes in the marketplace, okay? So we have chosen, price per square foot, when you think of it under these lenses, really becomes more of a distraction. So we've decided not to follow that distraction and instead to focus on supply and demand. And that's where the interplay between supply and demand, that's where you can have theoretical clarity when the data is otherwise very obscure.
So you find a baseline? What do you do? Try to boil it down for our viewers into like a really succinct message.
Yeah, so that's a good question too. With supply and demand, we use as a baseline just because of comparison, just to know, like Robin said, where do we stand? Developers want to know what did the past look like? That's really your baseline, and we use a 10-year moving average. And then from that, we can see, are we above and below, and why? And then what we do is, again, this is where the preconceived narratives come in. So just to give a sneak peek into our Q2 report that will be out next week, or available next week, demand is certainly down across Brooklyn and Manhattan, okay? And most people will say, okay, that's clear, it must be tariffs, okay? Because that is certainly a viable reason. Mm-hmm. But when we dig into it deeper, first of all, we're ignoring price, we're not distracted by that. We also can see that maybe it's not a demand problem, that it's a supply issue. Because where there is supply that people are interested in and it's well priced, that the absorption rate is actually very quick and the demand is actually very strong. It bucks the curve, so to speak. So these are the things we're looking at. Where again is traditionally the thought process has been, let's track this price per square foot, and that's going to tell us how the consumer feels and how the city's performing.
I like that.
Yeah.
That makes a lot of sense. We'll be right back, and when we come back, we're going to hear how Robin uses this data to discuss and consult our clients.
I'm Brian Scott Cohen, one of the top loan originators in the country and the #1 mortgage originator at Guaranteed Rate Infinity. Guaranteed Rate Infinity arguably has the most advanced tech in the industry. Our completely digital loan process makes it easy and efficient for homeowners, from a 15-minute pre-approval to the digital application and through closing. My team and I would love to help you get into the home of your dreams.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
All right, so Robin, we have all this great data that you and Jason are creating, and we're looking at it a different way. How does that help you consult our clients in a different way than it did before we started to look at the data the way that we're looking at now, which is much more supply and demand based, less focused on the actual dollars and cents?
Yeah, I mean, I think the current state of the market, we were in an oversupplied, declining market in New York City for many years. And coming out of COVID, the supply levels were roughly around 6,000 units. And in 2020, coming out of COVID, we had a banner year. I think we did over 2,000 units. And what we're seeing currently is the supply is continuing to decline. We're probably at the lowest number of units in Manhattan new development in over 10 years. And what's amazing is the absorption continues to actually stay steady or even increased. And I think that's really a tale of two tapes. One is we're finally seeing some new product coming online, such as 520 Fifth Avenue, which was a great success. Some of the new boutique projects downtown, like 125 Perry Street, even though it's only 5 or 6 units, we saw it got absorbed tremendously fast.
Yeah, or the Catherine also.
Catherine by on that Slate Property Group. It did at 118 West 13th Street, to the Jane Street project on the water, and Zeckendorf's most recent development on 80 Clarkson. But besides those success stories, we're also finally seeing some of the developments that, lack of a better word, had aspirational pricing. And the aspirational pricing is finally starting to come down, which is creating some absorption of buildings that have been on the market for probably 3, 4, 5, and believe it or not, even 6 years. So combine new product that people have been waiting for in supply constrained neighborhoods, plus developments that have been lingering and prices finally coming down, is helping us maintain positive absorption in Manhattan.
It makes a lot of sense. So, Jason, we talked a little bit about like what's selling, what's not selling, and supply and demand, right? So Robin mentioned there are some buildings that have been out there for a long time. They finally started to adjust some pricing. Help our viewers understand just how much inventory is kind of real inventory versus inventory that didn't sell well. Maybe now they're finally starting to get their pricing right. But, when people look online, they might see 6,000 apartments in new development, but are there really 6,000 apartments that are really sellable today in new development?
Yeah, that's a good, and this is really Robin's story. I have the privilege of answering this, but this was really his idea that we dug into on the research side. So right now, there are about 3,900 units out there. Now, some sites list ones that are coming soon, essentially. So that would make it more, but I mean as that are for sale right now. Robin said, because again, when you look at that on a historical level, it's lower, but it's several years worth of, right? It's 36
We
months
sell
or so.
approximately 1,600 units per year in Manhattan new development.
Exactly. So you're talking about, between 2 to 2.5 years of product. So that doesn't feel particularly tight or there's not enough inventory out there. However, Robin had the idea, and it was a great one, and we looked at it to say, what about the top 5 buildings? It was just almost arbitrary, right? What about the top 5? And when we looked, a third of the inventory is in the 5 buildings with the most inventory, right? So, and it comes out to a third is about 1,300 units. So the point of that is, if someone's not a buyer for those buildings, they just don't like that building for whatever reason, well, their perspectives are cut by a third. And then again, people are not agnostic to neighborhood, like they do care most of the time about being in a certain neighborhood. So it just gets cut and cut and cut, right? And then the other thing that, again, it was Robin's research project that I just jumped into, and I had fun jumping into these things. That's what I do. Is he said, wait a second, what buildings have been on for 4 years? And again, the point of that was that people have had the chance to look through these. Like they're not new, they're not exciting. They're more exciting when they cut the prices, like you said, and that also is a third. Now, that doesn't mean that 3,900 is cut by a third and a third. There's some overlap in the top 5.
Course.
It just means that from those two lenses, that instead of there being 3,900 units out there, or about 36 months of supply, there's 2,600 or so, which is about 20 months of supply.
Yeah, just about 2 years. Yeah, so which is historically low, because historically we've had about 4 years of supply in new development.
Yeah, the average. Well, that's exactly right. The average is about, over the 10 years, is about 4,800.
Right.
So we're lower than that anyway, but it's not alarmingly low until you start to dig in a little bit deeper.
And
see
we've
that maybe it
only,
is.
I think, introduced approximately 2,000 units to the marketplace in the last 2 years.
Right.
Yeah.
Right.
That's
So
right.
so development trends in Manhattan are still relatively low. You drive around the city, you don't see a lot of cranes in the sky. A handful. Maybe the Upper East Side is probably the only neighborhood that really has a deep pipeline coming in the future.
That's right.
And that's only really occurred in the last 4 to 6 years, because before, the Upper East Side was lacking in inventory, and it was the Upper West Side and downtown that was leading in adding inventory to the city. So it's also very interesting how the development cycle doesn't just move with price points and unit sizes, but actually moves with neighborhoods as well.
Yeah, I mean, and I guess that's another thing that came out of COVID is a lot of people moved back from downtown to uptown. But now we're hearing about people that want to be back downtown with, with 80 Clarkson and some of these other projects. So it is interesting to watch the trends and the demographics too. I mean, I think that we talk a lot in our developer meetings about the empty nester and the pied-à-terre. It is the deepest part of the development pool. There are plenty of people, and I think this also, when people sold some of their suburban homes and some younger families moved out of the city, it brought some empty nesters back, and that's a trend that we continue to watch.
Yeah, absolutely, and those empty nesters also helping their adult children buy apartments as well, right? So a high cash environment, which is why in our next segment we'll talk a little bit about how interest rates affect or don't affect the Manhattan real estate market, and also what's coming in the pipeline. We'll be right back.
Hi, I'm Evan Greenberg with Langdon Title. I specialize in title insurance across New York, helping real estate attorneys, agents, and brokers close with confidence. I solve problems fast and keep your deals moving. Contact me anytime.
Ultimate Diamond is New York City's most established family-owned jeweler. With over 65 years of experience, Ultimate is renowned for its exceptional, custom-crafted diamond jewelry, its bespoke engagement ring designs, and its ability to source rare, distinguished timepieces. Ultimate has built a legacy of timeless craftsmanship and discretion, making it a trusted name among those who value refined luxury. Learn more at ultimatediamond.com.
All right, and we're back. So in our last segment here, let's talk a little bit about what's coming to the market. What are you excited about, number one? What's in the pipeline that people should keep their eyes open for? And where are the holes in the market? What supply is lacking? And what areas of the city might need more development in the future? And Robin, obviously, the City of Yes and the Midtown South rezoning all comes into this as well.
Yeah, I mean, we are finally starting to see more development sites trade. We started to see it pick up in, I would say, January, February of this year. We all had a little pause with tariffs, right? But it seems the market is coming back to life. And where are the holes? I think the most limited amount of inventory today is really under $3 million. I think that percentage for a new development buyer is under 24 months of supply. So that's a really tight place in the market where we could see some more inventory.
Yeah.
Yes, the high end has been strong, but believe it or not, there is, I think, over 5 years of supply that still exists in Manhattan new development over at $3,000 per square foot. So
is that more focused in one specific area of the city? Or?
Yeah, I think probably you still have plenty of inventory to be moved along Billionaires Row. The prices at Steinway Tower certainly came down, and we saw a tremendous absorption in that building over the last 12 months. There's still some inventory left at Central Park Tower, and I think it'll be interesting to see Extel's first project on the Upper West Side. I think will be completed by year end, and it's I think somewhere around 70% sold. And just this past week we saw they submitted their new plans for the Disney site.
Right.
So that will be the next big tower coming by Extel on the Upper West Side, and then the landscape of the Upper East Side is just constantly changing. I think that there are 7 new developments that are in the planning stages currently, and you will definitely start to see some of those condo towers come out of the ground end of this year into next.
That's exciting. Jason, 2 things I wanted to ask you about. One is the impact of interest rates on the New York City marketplace. We talked about tariffs impacting the marketplace, but everyone talks about interest rates impacting the marketplace. But as you dug down into the data, you found something a little bit different.
Yeah, so when you look at the chart, right, when rates hit their lowest point, which is under 3%, you did see a climb, okay? Now, is this causation, correlation, or just coincidence, right? That also coincided with the vaccine during COVID, so this is in 2020, the end of...
So a lot of pent-up demand.
That's right. So these are what we say that there are always several viable reasons for anything happening, right? On the other side, in 2021 and 2022, there was this great, like you said, the pent-up demand, a great boom. And also, right on cue, when mortgage rates reached about 4.5%, that tailed off very quickly. That demand came. Now, it didn't drop in the sense of it went negative. It's just that it came back to the long-term moving average that we follow. But again, we don't know whether it was just demand was pulled forward and that was the end of that period of demand and things normalized, or was it actually because of rates? But now here's what we do see, was that since that time, since rates have been for the last essentially 2 years moving, or not trading, but being priced in between 6 and 7%. And what Robin mentioned earlier, that yes, demand is down. We don't panic about that or really make too big of a deal about it because it's all relatively flat the last couple of years. But what that tells us is that despite this mortgage uptick to 6 to 7%, demand is totally normal based on the 10-year.
Right.
Now, not only is that good because New York City is going through these headwinds such as, well, tariffs for the whole country. But we had COVID was an epicenter here because there's such density, and it came out of COVID. The mortgage rates, nothing really, it's almost like, impenetrable, this New York City demand. And the good thing about higher mortgage rates, this sounds terrible to even say. A lot of homeowners are angry right now, right? If they purchased at higher rates, right? But there's more cash in the market. More people have equity. And that's what helped New York City during the financial crash.
Absolutely.
Was it when you think about co-ops, a lot of the city is co-op, right? And there's a lot that allow light financing or none whatsoever. It's all equity. And condos now, when people are saying, you know what, mortgage rates are too high, I'm just going to use cash. And like you said, parents helping purchase for their adult children. When you see this amount of cash and equity in the markets, if there is another downturn, that's what buoyed New York City, where some of these other major cities were down. I mean, you heard these stories. I had to research to believe it, but even 60, 70% on some of the new development in other large cities.
Right, yeah, because people become underwater very quickly. Here in New York City, that doesn't happen. So you don't see the foreclosures. You didn't see the panic selling here in New York like you saw across the country in 08, 09, because the people weren't over-levered, whether that was the co-op board keeping financing reasonable or just a lot of cash coming in, for purchases.
That's right.
The other thing that Robin mentioned a couple of minutes ago was that there's a lack of apartments under $3 million, which is interesting because our data shows that's where the highest absorption is, right?
Right.
Is in units under $3 million, particularly I think it's 2 bedrooms under $3 million. So, Robin, if that's the case, if developer calls you tomorrow and says, what do I build now? If it's a Class A location and it's all going to be half floors or full floors, it's one thing. But let's say it's a B plus location. Are you pushing for 2 bedrooms under $3 million? Are you going to make those apartments smaller to hit your price per square foot? How do you address it?
I mean, I think first it comes down to the development site. Right?
It's all about the envelope.
All about the envelope. What can you build, and what's going to produce the best product? But for the most part, yes, I'd agree that the 1 and 2 bedroom market is needs product. We continue to hear about the parents buying for children that are college age. The Asian demographic coming from China is I think more robust than people talk about or see. The beauty of our business is that we get to see tremendous traffic on a regular basis and really learn about trends in the marketplace. So for sure, 1 and 2 bedrooms, and then where is really the big question, right? So neighborhoods like Chelsea, the Village, Soho, any of these neighborhoods that are typically supply constrained over years, they just need more product. The Lower Manhattan, Midtown East still to this day have the most condo inventory. I think if you add up Lower Manhattan and Midtown East inventory, it's like a third. It could be more.
That's right.
It could be more.
Right. Exactly.
So it's definitely neighborhood focused on what we should be planning and why. And that's what we're hoping to see is getting more product in some of these constrained neighborhoods.
Yeah, absolutely.
One interesting part on that is Robin's exactly right. 1 and 2 bedrooms are the most, and we don't say undersupplied because they're supply, but offer the least supply. And also, like you said, Steve, before, under 3 million. But what's interesting is sometimes when you look at the raw numbers in unit count, it doesn't appear that way. There's a large number of these out there, but that's another thing we do in our reports is we speak the common language across all bedroom types. Is that we don't speak, we list, of course, the number of units, but we speak in terms of months of supply.
Right.
So 2 bedrooms, they might have the most raw units, but in terms of months of supply, it could be among the least.
Because the demand is so high.
Because the demand is so high, right? So it's very important, and we do that, and we've done that to speak that language.
Yeah. And all this work that we've done over the last year or so to produce this report has been a tremendous help when anybody calls. I mean, it's like you call us about a specific development site, and it's literally we open up our library, right? And we just press some buttons, and we know what exists in certain markets, and that's the key. It's the key to being able to advise our clients, where to push, where not to push, where to get aggressive, and where maybe to not go forward.
Right. It makes the market for us much more predictable as we're looking into the future, which is, as you mentioned earlier, that's what stock analysts have been doing for decades, right? But in real estate, it was always looking backwards.
That's a great point.
And with you coming on board and with Robin's insight into the marketplace And your experience, by the way, as a broker, which has been really a great benefit because you understand the dynamics of the market, now we're able to really properly predict where we see things going in the future. So when a developer comes to us and says, I need X dollars per square foot, where in the past we might have been a little bit hesitant sometimes, right? We have a stack of proposals where unfortunately we were right and the developers ended up underwater. There have been a couple where maybe we were a little conservative. Now with the information we have today, we don't have to be as conservative because we can look at those trends and we can see how the market continues to absorb and accept higher price points in certain marketplaces, in certain types of units, in certain neighborhoods of the city.
Yeah, and our report is the biggest missing component in new development right now is equity and capital to back our developers. And I think that, I know that our data and the research that we've been able to produce and present to our clients and their capital partners has made deals happen. It's pushed projects forward when people were out trying to find capital, whether it's equity or debt, and that's the difference. It's being able to dig into it and show somebody why it makes sense to proceed, because these are millions of dollars at stake, and that's the beauty of the team and the research that we were able to put together.
That's really well said, and it's a great way to end our conversation. Guys, thank you so much. Predictive analytics is the name of the game. See you next time.